Welcome to Market News. I'm your host, and this is Thursday, July 30th, 2026. Let's jump right into it, because today the tape tells a story of two very different narratives playing out at once. On one side, you have AI and semiconductor stocks staging their best single-day rebound in some time. Intel and AMD each soared 13%. Taiwan Semiconductor rallied 7%. The Nasdaq caught a bid from the chip sector and managed to turn things around. But on the other side, and this is where a lot of the real story lies, you have Wall Street increasingly uncomfortable about how much money big technology companies are dumping into AI with no clear timeline for returns. Meta was the poster child for that tension. If these two forces cancel each other out, that's what today's market looked like. A bounce on infrastructure names, but skepticism about the spenders. Let me start where the most volume was today, because Nvidia closed at $190.01, down 3.5% on 148 million shares. And you know how that can feel frustrating if you've been watching this stock. It's languishing below the $200 mark, pulling back, yet the chatter around Nvidia did not fade. A few different outlets picked up on the idea of what analysts from ARM's Renehaas described as a hyperscaler prisoner's dilemma. The theory goes like this: every major cloud provider, whether it's Microsoft, whether it's Meta, whether it is Google, these companies are locked into an arms race where they have to keep spending on AI infrastructure, and Nvidia GPUs remain the workhorse even as they cut their own chips. Google's TPUs, too, are now being framed as validating ARM's own AI bets. Every AI workload, that's the quote from Haas, is going to run through ARM. So even when Nvidia itself is down on the day, the conversation keeps pulling investors back to it because the underlying assumption is that CapEx is not going away. That's the narrative thread tying together Broadcom, AMD, Marvell, the SOX index, and yes, Nvidia even when it's posting a 3.5% decline. But let me pivot to Meta, because if you wanted a single stock that captured the sentiment of this entire market, Meta was it. Meta was the most mentioned stock across the headlines today. The company reported a second quarter earnings miss and shares fell. Reuters, Bloomberg, WDBUSH, 24/7 Wall Street, every major outlet was covering Meta's rising AI capital expenditures, and the central question was not whether Meta is spending a lot, but whether it's spending too much too fast. Investor sentiment was far from uniform. On one side, you had bullish threads trying to frame Meta as having built a win-win AI risk profile. But the dominant narrative was much more skeptical. Investors were asking whether the speed of Meta's spending would deliver proportional returns. The one positive note from the company was that AI is making it easier to build new apps at Meta, and more are coming. But that's forward-looking language, and the market right now is punishing forward-looking language when the numbers behind it aren't there yet. Meta risks its empire as it splurges to keep pace in the AI race. That was the framing from Reuters. And Bloomberg framed it as Meta's AI spending facing a Wall Street test. Those are not gentle frames, and they reflect exactly where sentiment landed. Now, Microsoft was the big counterweight to all of that. Microsoft posted a strong fiscal fourth quarter beat, and the headline number that everyone was watching, and Motley Fool called it the most important earnings figure, was $19.6 billion in Azure cloud revenue. Post-earnings pop pushed shares higher, and it genuinely mattered for the broader tape. Microsoft's move helped offset lagging Dow components, providing direct counterweight to Meta's weakness. And let me put this in context. We saw earlier this week a Dow plunging roughly 800 points. Today, Microsoft's earnings pop was one of the few bright spots supporting the Dow. It's a reminder that not every AI spend has been meeting the same level of scrutiny, and Azure's cloud growth offered a model of returns that the market is still trying to find elsewhere. On the earnings side, MasterCard also reported second quarter results that topped street estimates, another positive story in a day full of mixed signals. But L3 Harris Technologies plummeted on the day. In the defense and aerospace name, the weakness was sharp and notable. And then there was the notable quote from Jim Cramer, who said when margins go down big, you have to buy what was blown out. 5 stocks to consider, including Google, Meta, SoFi, Intel, Nvidia. He was pointing toward names with damaged valuations that he believes have already been sold off too far. Let me walk through some of the notable movers because what popped today was as extreme as usually. Vine was the day's biggest gainer at an extraordinary 5,511%. Now, when you see a move like that, it's a tiny float speculative spike. Yas jumped 370%. Encross surged 118% on massive 127 million shares. DFNS climbed 109%. SBRC was up 70%. Amex gained 66% on 70 million shares. You are looking at a very small cap-driven move on the upside. Most of these gainers are names with low bases and speculative flows. On the flip side, BCPC crashed 85% down to $24. NIPC fell 40% to $9.01. MBRX dropped 38%. PSN fell 35%. These are not names that move the entire market, but they tell you about where speculative energy is flowing. On the volume side, SoFi was the most actively traded large-cap name, down nearly 9% on 194 million shares. Nvidia again at 148 million, Intel at 152 million. Netflix jumped nearly 6% on 7 million shares, though the headline change percent was listed at something around 5.5 trillion%, which clearly an anomalous read. We're going to leave that in the category of data anomalies and not dwell on it. Speaking of Netflix, Netflix secured a global streaming deal for The Walking Dead, which is a big franchise play in the catalog content space. And separately, Netflix was flagged as a high-volatility portfolio diversifier. Interesting framing, that Netflix can diversify your portfolio, just not gently, which was the way Treffis put it. A few other headlines worth wrapping up. Qualcomm was cited as facing margin pressures and custom silicon risk from Apple, which is a longer-running narrative about whether Apple will continue relying on Qualcomm chips or build out its own silicon. United Health saw fair value targets lifted after second quarter analyst upgrades. Verizon data was highlighted as a metric that could keep the VZ stock climbing. The NextEra Energy Board declared a quarterly dividend. And perhaps the most interesting macro read came from a veteran investor who suggested AI's easiest gains are behind us and pointed toward Bitcoin. Whether you agree with that or not, it's a notable signal shift. When veteran macro investors start pivoting away from AI equities toward crypto, you pay attention. Let me now talk about the technical signal landscape, because today it painted an overwhelmingly cautious picture across the broad market. 10,560 symbols were analyzed. The scanner returned 10,652 total signals. Of those, only 9 were classified as bullish. 41 were bearish. That's an extremely heavy skew against the market. And here's what's interesting. The top bullish names were FI, TRIB, DPGI, SGLI, and DFNS. All of them showing strong momentum up. But every single one of those 5 also appeared on the bearish side of the ledger, where they were flagged for overbought territory or potential overextension. In other words, the same names that are showing strong upward momentum are also the same names flashing warning signs. This is the kind of technical setup that says the moves have room to extend but also room to reverse sharply. And then there's JDZG, which appeared with an overbought signal on the bearish side without a corresponding bullish entry. So the signal picture is overwhelmingly heavy, but concentrated in momentum and overbought categories rather than a broad-based breakdown. So here's the bottom line for today. AI and semiconductor stocks staged a sharp bounce, and Intel and AMD gave the market its best single-day move in some time. But Nvidia remains under pressure, trading below $190 on heavy volume, and the broader tech complex is wrestling with earnings-driven sentiment shifts around capital allocation. Meta's spending question looms large. It reported a miss. The capital expenditures keep climbing, and Wall Street is skeptical about the return's trajectory. Microsoft, on the other hand, showed the market what AI return stories look like when they work, with $19.6 billion in Azure cloud revenue. And across the full breadth of the market, technical signals are overwhelmingly cautious, with nearly all bullish setups concentrated in names that are also flashing overbought warnings. That brings us to the end of today's episode of Market News. We'll be back tomorrow with another look at what moved, what mattered, and what's coming next. Until then, stay sharp, stay cautious, and we'll see you on the tape.